Hi everyone, welcome back to my YouTube channel. Today we're diving into the fascinating topic of floating exchange rates, a key component of how currencies function in our interconnected global economy. In this video, we'll explore the history of floating exchange rates, the factors influencing them, and their benefits and limitations too. So without further ado, let's dive in. To understand floating exchange rates, we must revisit the mid 20th century when the global economy relied on the Bretton Woods system. Established in 1944, the system fixed exchange rates by pegging major currencies to the US dollar, which was tied to gold at a fixed price of $35 per ounce. This arrangement aimed to stabilize international trade and prevent competitive devaluations. Central banks used the US dollar as a reserve currency and intervened in the foreign exchange market to maintain exchange rate stability. By the 1960s, cracks began to appear in this system. Rising inflation, trade imbalances, and speculation against major currencies, including the British pound, strained its foundation. In 1967, the pound was devalued by 14.3%, and growing instability in global markets led to increasing pressure on the US dollar. In 1971, President Richard Nixon ended the dollar's convertibility to gold, effectively dismantling the gold standard. By 1973, the Bretton Woods system had collapsed, and major currencies like the US dollar, yen, and pound began floating freely. So, what exactly influences these exchange rates now? Floating exchange rates are influenced by a combination of economic fundamentals, global events, and market sentiment. Long term exchange rates are primarily determined by factors such as a country's economic strength, interest rates, inflation, and trade balance. Higher interest rates in a country attract foreign capital, increasing demand for its currency and driving its value up. Similarly, a strong economy boosts investor confidence and raises the currency's value, while high inflation and trade deficits can lead to depreciation. Short term fluctuations are often driven by market sentiment, speculation, and global events. Geopolitical instability, natural disasters, or even rumors can cause rapid changes in currency values. For instance, if investors perceive a government as unstable, they may lose confidence in its currency, causing it to depreciate. Although floating exchange rates are largely determined by the open market, governments and central banks sometimes intervene. For example, central banks may buy or sell currencies to stabilize values or adjust interest rates to attract foreign investment. Supply and demand dynamics also play a crucial role, with generally higher demand for a currency strengthening the currency's value. Floating exchange rates offer several key advantages that make them an integral part of modern financial systems. One major benefit is their ability to adjust automatically to correct trade imbalances. For instance, when a country imports more than it exports, its currency value typically depreciates. This makes the country's exports cheaper and more competitive globally, increasing demand and gradually restoring balance in its balance of payments. This self correcting mechanism reduces the need for frequent government intervention. Another advantage is the flexibility and independence they provide to governments and central banks. Unlike fixed systems that require large foreign reserves to maintain currency stability, floating exchange rates operate independently, freeing up resources for other priorities. Additionally, floating exchange rates reflect a country's economic fundamentals such as inflation, GDP growth, and interest rates, offering a transparent and real time snapshot of the economy. This transparency helps businesses, investors, and policymakers make more informed decisions. Floating exchange rates also enhance market efficiency by letting supply and demand determine currency values, encouraging fair competition and efficient resource allocation. They attract foreign investment to stable economies, boosting growth. Moreover, floating exchange rates act as a buffer against global shocks, allowing currencies to adjust gradually and helping economies better absorb external pressures. This adaptability makes them particularly valuable in a dynamic global economic environment. Despite their benefits, floating exchange rates come with notable challenges. One of the biggest drawbacks is their inherent volatility. Currency values can fluctuate significantly within a single trading day, creating uncertainty for businesses and investors. For example, a sudden depreciation can increase import costs, while an unexpected appreciation may harm export competitiveness. Floating exchange rates can also exacerbate economic issues. For countries already struggling with high inflation, further currency depreciation can worsen the problem. Higher import costs from a weaker currency can lead to inflationary spirals, putting additional pressure on the economy. Similarly, countries reliant on foreign debt may face challenges if their currency weakens, as repayment costs in local currency terms will increase rapidly. Another limitation is the potential restriction of economic growth. For instance, if the US dollar appreciates significantly against the euro, American exports become more expensive for European buyers, reducing demand and impacting export driven industries. Finally, short term speculation can destabilize floating exchange rates, particularly in smaller or emerging markets. Speculative activity can lead to rapid depreciation or appreciation, distorting market signals and placing additional strain on governments and central banks. In conclusion, floating exchange rates play a crucial role in the global economy, offering flexibility and reflecting the economic realities of individual countries. They provide a dynamic system where currency values adjust according to market conditions, helping to correct trade imbalances and promoting economic stability. However, their inherent volatility and potential to magnify economic challenges such as inflation and foreign debt costs make them a double edged sword. While they offer advantages like autonomy for governments and transparency in reflecting economic fundamentals, they also create uncertainty for businesses and investors. Understanding the dynamics of floating exchange rates is essential for navigating the complexities of international finance and trade, as well as for anticipating the potential risks and reward for participating in global markets. So, that wraps up this video. Thanks for watching. If you enjoyed this video, please like and subscribe to stay updated on more finance and economics content. See you in the next one.